All right, so stocks responded relatively positively to the FOMC minutes coming out, with the idea that maybe the Fed might not raise rates 50 basis points in March. So we're going to break down the how the market looked going into that minutes release, and then what the response afterwards, and how the day ended up, and now what are our expectations? Like, are we going to continue this short-term rally? Where is there some resistance levels? What will we do there? What's the expectation? Are we going to continue back to the downside? Are we going to go upward? A lot of that depends on a lot of these other asset classes and where they're at right now, and with some of the patterns that they're showing. So I'm going to break down things that are like bonds and the dollar and Bitcoin and different other asset classes to kind of get an idea of risk appetite as a whole in general across the spectrum. And then we're going to take a look at a stock that's very similar to a lot of stocks right now that has a pretty well-defined consolidation pattern on a bearish trend that could be breaking out of that consolidation pattern. We'll talk about how to trade that in that case. So let's go ahead and get started. Today is Wednesday, February the 16th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, nice little rally, two-day rally here, barely closing above, what, 900ths of a point, but we did get positive after being negative for a good chunk of the day. The near-term line did rally into the into bullish territory, did not get in the upper reversal zone. That's something that we need to check out tomorrow. If we can't follow through today and finish filling in that gap to the 30-day moving average up to this 50% retracement, if we can't do that tomorrow and push this near-term line well into the reversal zone, and we turn back down and come back out of bullish territory, then that's a really bearish near-term high point. When it gets up into bullish territory and it's not able to get above 80, and it's also associated with a lower high point, I mean, that would be very likely we get a new lower low, a new lower near-term low point. And I mean, again, very similar to this one. This was a near-term peak. Again, got into bullish territory, did not get above, and then we did get a new lower low. Obviously, a big time lower low point there. So that's the idea, and that's what we want to avoid, right? And you can see even this one here, again, another example of not getting in the reversal zone. And then by the time we got the new near-term low point, it was a much lower near-term low point. So, and considering that we're already dark pink shading in a red line, a new lower low point would probably start to look at filling in this range here from the Monday after January expiration. We are a percent below the moving average. The intermediate line is in bearish territory itself. It's dropped now below the 40th percentile. The market sentiment line's falling still, and still in the upper half of the chart, but falling down. So the intermediate line never did get above the market sentiment line. The Nasdaq 100, you can see its near-term line did get in the reversal zone, but again, not to strong levels. So it's still obviously would be associated with a lower high point here. Its near-term line or intermediate line did not get above market sentiment, but in this case, they're both now easily in bearish territory. On the Nasdaq, your Russell 2000, its market sentiment line's been in bearish territory for a while now. Its intermediate line is trying to get out and is looking like it might not be able to. The intermediate line, the near-term line, did get into strong levels, well up above the 90th percentile. But this is the third one. Unlike these other two, which were kind of higher near-term peaks, slightly higher. This one is not quite slightly higher, right? It's kind of equal. In this case, getting a yellow line, right? We're above that falling moving average. We haven't had that since over here. Haven't had a yellow line for a while. So we'll see if this little wedge, if this turns out to be a wedge pattern, a consolidation pattern, and we come out of it with a new leg lower to the downside. We are only 0.5%. Over here, we got up to less than 2% above the moving average before things rolled over to the downside. If we take a look at the Dow, which has been your most bullish index and kind of your blue chip, its intermediate line is also falling. It's gotten below the 50th percentile. It's not in bearish territory yet. It came back below its market sentiment. And you can see, we are dark pink shading and a red line. So we are less than a percent below the 30-day moving average. It also would be a bearish near-term peak if this holds. So it's very important tomorrow and going into Friday that we either follow up with a good strong near-term push similar to these, or if we turn back down, then it's going to give us an an idea of how things might be more bearish. At least over here you had dark green shading and a green line. This obviously we would get the same pattern, but in a much more bearish environment, being already dark pink shading and a red line. Let's take a look at the long-term view here for the S&P. Again, getting that bearish candle, a little bit of an upper shadow there, and so obviously still no green arrow. Your Dow Jones Industrial Average looks very similar. Is not quite closing below that moving average yet, the 40-week moving average yet. Your NASDAQ is right now trading below the 40-week. For multiple weeks now, we've had 4 or 5 Hakinyasha closes below the 40-week moving average, to the point where they're really the gap between the two has really shrunk down to almost nothing. We have that negative differential there. Your Russell is in a death cross, so not only is it below the 40, it's also still below the 10's below the 40 now. So that shows you how bearish the NASDAQ is, or Russell has been relative, and its PPO is down a few down to about -3% there, and the differential is not getting very strong. Very, very weak bullish candles. As you can see, when you're bullish, you get good strong bullish candles to start off bullish runs, and this so far is not a very strong bullish candle, to say the least. Let's look at the 3 green arrow charts, and you can see we did get a green arrow again on the MACD, so histogram's rising. Very, very low volume though, 84 million shares trading, very small trading range. Very small. I mean, that's not very typical to get small volumes and small ranges when you're still below these moving averages. But that's what we're getting here. We got the red arrow and the very flat histogram on the diamonds. You got the red arrow on the stochastics with a green arrow on IWM. You got that yellow, kind of that. We had 3 green arrows yesterday. That's why you had the 1 day of light green shading. But now we're back to not getting, because of the red arrow, we don't have the green shading anymore. And then your NASDAQ looks very similar to the S&P with a rising histogram there on the MACD. Looking at the 2-line versions, you can see the rally today on the S&P got you up just a smidgen above the 8-day moving average, still on an intraday basis holding the 17-day. So we're still kind of in this bullish convergence mode. We haven't really diverged yet back to the downside. Your Qs are very similar. We did finish just slightly above the 8-day, but you can see we're below the point of control in the Qs. The 30-day is now crossed below the 200-day moving average. That's the next stage in bearishness. Now you just watch for the 50-day to cross over. And as I mentioned in my class at Market Scholars yesterday, typically, when in other instances, immediately following the 30-day crossing below the 200, you tend to get a little bit of a rally, in this case probably up to that point of control, maybe up to the 200-day moving average. But then, again, if it holds the 50 at that point and rolls over, then we continue with the corrective mode. So I wouldn't be surprised if we don't get a little bit of some bullishness now that the 30 is crossed. You can see here that we were in the state of bullishness as the 30 was crossing. We hit the 50 and then rolled, and that's when it was the most bearish, coming after that. So eventually the 50-day cross. So that's the kind of move that you would expect that we may get on the Qs now that the 30-day. Keep in mind the spiders, we still haven't got the 8 and the 17-day to cross below. So we're still in very, very early state. In fact, actually the price is still above the 200-day moving average. So if we are in correction mode on the S&P, not to say that we are, but we are in the Russell, right? Because we're in death cross environment there. But for the S&P, we're not. We are very, very flat. In fact, I mean the moving averages are tightening up, and you're almost to the point where all of them are between that Fibonacci, inside of that Fibonacci retracement zone of this drop. It's a very, very tight range that the broad market has been trading in for the last however many days that all these averages reflect. If If you take a look at some of these other oscillators, the DMI, the negative is still above 25, the positive is still below 20. So nothing's really changed there. That's the case for all these patterns. So all bearish. The only one that's not is IWM, but it can't get as negative up above 25. And even when it did, the one day it came right back down and new leg lower, right? So you got that. You got the negative is down below 25 and it's flirting with getting below 20. But you can't, follow that with a blue line crossing up above 25, which would signal that we're bullish here. So that's not the case. And the RSI, same thing. We're still at bearish levels. We're in the lower halves of these charts, not in the upper halves, which is what we'd be if we were bullish. That's the case on the S&P and as well as on the Russell. You can see we've been a little bit more bullish. We might be diverging a little bit here with this peak. And with this peak getting so strong, but the RSI not confirming that, not getting itself up into strong bullish levels. Finally, looking at the Bollinger Bands, you can see the bandwidth has been falling, but we're still in the middle of the bandwidth, and the last couple of days getting back to the middle, trying to push into the outer half of the bandwidth as much as we can, and we're not really able to do that in either one of these. And the S&P is on the other half, the other half of this 50, but again, not into the outer half yet, not to that. In this case, would be the upper quartile. It's still kind of, and again, we've seen this picture before where we got up about this far and then rolled over for a new leg lower to the downside. If you take a look at today's intraday move, we started to fill in yesterday's gap, so I still expect we'll probably fill in the rest of that gap, if not tomorrow. Or Friday in expiration, we'll probably fill in that gap by next week, because I expect that we'll be relatively bullish over the next couple of days. Not very much, right? Just up into this area, this 450 area, maybe up towards 453, up towards that area. So we'll probably get up into here and the stall over the next couple of days until we get through expiration, and then I expect that we'll fill in the rest of that gap starting next week as we head into March expiration for the next 4 weeks. And of course, that's going to be a really important one because the FOMC meets that week, that Wednesday of March expiration. When you look at the amount of volume we had, what do we have here? 6-point range, 84, almost 85 million in shares trading hands. So 85 million would be down, way down here, well below the average. Just over 6-point range is way down here. So those are very small numbers that you'd expect to see when you are above moving averages, not below them, right? So we're still below all of them except for the 200. That's not you don't want to see small moves as you head into these moving averages. Really small moves. That typically suggests that the bulls are going to have a hard time getting you through this resistance area. Finally, looking at the VIX here, you can see that the VIX has been pulling back, and at the end of the day today, it pulled into the middle of that neutral zone down at the bottom, right about the 92.5 percentile, just barely below 95 though. So we are in a higher volatility regime right now, and that continues to be the case for the VIX. The VIX is higher, and we pull back. We're sitting at that 30-day moving average, and we can still flirt with that and get to the 50 and still be above 20, right? So volatility is higher. That's the 200-day is almost above 20 itself again. We've been above 20 for most of this past few expiration cycles. That's the phase of the market, and when the VIX is this high and you're getting ranges that are that small, that goes to show you that the market is still not quite is not quite bullish, right? Because you should get strong bullish moves with the VIX near 25, and we just did not get a strong bullish move today. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggests why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, that you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't like videos. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the right. Click on this icon right there, Market Outlook Live. It takes you to this page. This is where I do the market. I do every day on Monday, Wednesday, and Fridays at 3:30 Eastern Time. I do a Market Outlook live video here on this page. It lasts about 10-15 minutes. I review all the trades that we've done in prior Market Outlook videos to see whether we should stay in them or get out of them. I also look at today's trade idea that you'll hear at the end of the video. We've already put it on today before the market closed. We did it during this video live. You can see all the archives right here. You can also get to it by clicking on Live Trade Review in our main menu. Come down here and you can see our upcoming classes. Click on View More. You get an idea of all of our trading rooms and classes that we have throughout the week. We don't have a Saturday session this week because of the holiday, but you can see all the rest of our classes posted there. You can also get to that in trading rooms there in our main menu. Come down to the bottom, click that heart icon. It takes you to this tab. Hit that like button. Same thing with Facebook. Click on that icon. Takes you to this page. Click that like button there again. That really helps us out because it gets more of our the more engagements helps us get our content out to more of our followers. You can see the way their algorithms work. This post is only seen by 25 people, and there's obviously way more than 25 people that follow that page. So that's why we always ask for the engagements. The same thing with Twitter as well. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right now, right here, while you're watching the video. All right, let's take a look at what's driving the price action today. And you can see at the beginning of the day today, it was commodities and gold, and even emerging market stocks were doing really well. They finished the day pretty strong. Emerging markets outpacing U.S. equities. U.S. equities at the time were really down when those Fed minutes came out. And then they rallied. The Qs rallied almost to break even. The S&P and the small caps rallied past the break even point. And then equity, again, emerging markets actually rallied up to higher levels, and gold really took off. The dollar was down. Let's take a look at what those charts look like on another chart here. Let's take a look at the 12 grid here really quick for these different asset classes. You can see the dollar up there kind of flat, rolling over a little bit. The long-term bonds are very, very oversold levels. Down at the bottom, you can see gold is taking off. It's really kind of breaking out here up to the upside. Bitcoin has been trying to get going. It's got dark green shading and a green line again. Crude oil and commodities in general have had a dark green shading and green line along with the yield. So this is an inflation story going on right now with commodities, and with, when you look at DBC here, commodities and with yields and with the gold all rising, very much a inflation story. The dollar peaking and rolling over, even if its intermediate line is green, it's light green. It's down. It's not above the 50th percentile yet. Your silver and copper just really been flat, so copper's not really able to really follow through on that breakout. And global equities, including the S&P, is still in dark pink shading and red line. Developed markets, U.S. equities, emerging markets are actually above their moving average. Its intermediate line's above the 50th percentile. It's just falling right now. Otherwise, you got dark pink shading or dark green shading. You're close to dark green shading, the green line there. So you can see there's some asset classes that are doing much better than others. But you notice we're not in bullish territory. We're also not strongly in bearish territory either in terms of risk appetite in general. And a lot of your risk asset classes are actually doing pretty well. When you look at them on this chart, again, Bitcoin is kind of a reflection of the asset class. It's the most speculative, right? It's got the strongest. It's in a dark death cross environment. The 50 is crossed below the 200. But we're bullish lately, and we've been on this little rise of this post-COVID rally. This, if you take a look longer term on this, you can see this. It's actually coming from pre-COVID rally. The full long-term move on Bitcoin coming off of that $3,000 low point from the end of 2018. we're kind of at that 38% retracement level, kind of using it for a little bit of a resistance. But if you look at, this rally that we've had really since post-COVID levels, this COVID low point, so let's change this, let's activate this to the COVID low point there, and then you have the high. Then you notice now we're still kind of at that 38% retracement level, and hitting that for a resistance level on the way back up, right? So we've already broken below it, and all these moving averages are broken below it, and it's using it for some resistance. That's why we're getting a lot of headwind here at the 50-day moving average and below the 200-day moving average. If you take a look, there's still, a lot of this move has been relatively recent, especially if you just look at the last 2 years. That's the COVID move. You still got very, very little volume down below where we're at, and the top of the value area as well, sitting at the top at that 38% retracement of this drop that we're on. So lots of resistance in this area. It's, again, a sign of risk appetite on the furthest part of that spectrum, on the highest risk levels, and ARK Innovation having gotten below its 2-year value area and forming a little bit of a node here, also forming some resistance, and you've well in the bear cross territory, and you're way down here, and the MACD is been rising as you've been in this kind of bullish convergence, but like over here you got a bullish convergence and went to a new leg lower. It appears to be that's the case right now, that we're potentially forming a new leg lower again on Bitcoin, going back to the downside. So we'll see. We haven't gotten back above this 23% line yet, of this drop that we've been on pretty much since beginning in November, when we failed there at the 200-day moving average. Let's take a look at how long-term bonds, because those have been really moving pretty strongly. You can see we're back at these 2021 low point. If you take a look, the early February, March, that's where yields got to. The 2-year yield got up to about 1.75%, a little bit higher. We're obviously above that. We're at over 2% now. So it kind of gives you an idea of where the, TLT is not quite the 10-year yield, it's the long term. But you also see, you've got this much lower low point, but not necessarily on the MACD. So it's a little bit of a divergence forming at this level, at the 62% retracement. That's the 62% retracement of, if I were to zoom out here, of this rally that coming off of that fall 2018 when we had that bear market. That was kind of a fake bear market because you couldn't, FANG stocks really hit it from the U.S. equity standpoint. But you can see that's off of that low point. Bonds really rallied up to that peak post-COVID in August. And then we've been on this decline ever since, hitting that support once already, and then now potentially doing it again. So there's going to be a lot of support here for long-term bonds. To kind of give you an idea, the last time, we rallied when we hit that March peak. That's when small caps hit a parabolic peak, and then bonds kind of rallied off of that level going into August of last year. And so we'll see if we get that same kind of move again. Now going to the Euro US dollar, you can see here that it's been trying to break up. The MACD is actually positive here, so it's been trying to break up to the upside. Here, let me get rid of these Fibonacci lines, and you can see here, let me zoom out so I can see where those other lines are coming from. Yeah, so we have that one there, and we have this big long-term one. So here, let me change the color on this big long-term one so it stands out a little bit. There we go. So that's that. So that big one there goes back 15 years. Like we've been. There we go. So it goes back all the way, way back. There's that big long-term one. The big rally we had. All the way up to the 2008 peak, we've been pulling back. It's the 68% retracement of that drop, and this is the 15-year pullback. This trend line, that we are up above that trend line. So now this black line is this rally and subsequent pullback, and we're sitting at the 62% retracement of that level. So again, with the trend line and multiple Fibonacci levels, there's some pretty decent support in this area, and we've had some volatility, never getting below the 78. We've had some volatility here, but we need to get back above these moving averages before we're going to be like, okay, we're bullish on the euro. But it was a good day nonetheless, and we'll see if it does. I mean, the moving averages are right on top of each other right now. The 50 and the 30 and the 200 are right there. The 50 is on the other side of this Fibonacci retracement zone. So if we were to get up to above 117 and that 50, then we'd be obviously in a bullish divergence at that point and making a new leg high. In my opinion, making a new leg higher at that point. Let's take a look at how the sectors performed here today. So remember, it's kind of a tale of 2 days here. So we'll go to first. Here, let's just go to today first. And you can see initially energy stocks were doing really, really well. They pulled back after the Fed. Initially, it knee-jerked to the upside, but then really pulled back after the Fed minutes. They ended up the best performer, though, along with materials and industrials. You can see XLK, XLY, XLC were all down the most before those minutes. They still ended up being down quite a bit. XLK really, small loss. XLC not doing so well. And so those sectors, which are your big sectors, right? Those were your biggest companies are represented in the S&P 500 are all here. Easily dark pink shading and a red line. In fact, we're getting dark pink shading and red lines all across the board here. The only ones, again, that we're not is the outlier in energy and the semi-outlier in financials. Everything else, it's been pretty broad sell-off, and we're still below moving averages pretty much on every single sector that's out there. All right, let's take a look at Okta. That's our trade idea of the day. You can see it's got dark pink shading and a red line. This bearish trend has been alternating between dark pink shading and a red line and light green shading for pretty much since it broke down there in November, right there at November expiration going into earnings. Big breakdown there. It's been on a downtrend. The intermediate line's been pretty much below 40 this entire time. Market sentiment line is pulled down, though it never really got strongly bullish. We were so sideways for so long. Now we're finally in more of a bearish mode. We are more than 2.5% below the 30-day moving average. When you look at its long-term chart here, you can see we are obviously in a death cross environment, and we've had a few transition candles, but still easily below the 10-week, which is well below the 40-week. The PPO is down 10%. So we are definitely in a corrective mode, that's for sure, on this stock. When you look at its 3 green arrow chart, you can see the death cross here too. 50 is well below the 200, all below the point of control, all below the value area. And we've been kind of wedging up into that 30-day moving average, the MACD getting up close to zero, but now starting to roll over. Stochastic starting to roll over, just near the top of this bearish territory here, basically just like we did over here. So we'll see if we end up getting a very similar leg lower to the downside. When you look at the 2-year version of this chart, you can see we rallied so much over here in May of 2020 coming off the COVID low that's really that's the gap we'd be filling in if we continued lower. We're at the bottom of the 2-year value area. We were so sideways there for so long after such a strong rally. That was such a strong move to get up to the upside there. Looking at some of these other oscillators, you can see the DMI, the negative has dropped below 25, but the positive was trying to get up there and then has already dropped back below 20. So there's a good chance you'd expect that the negative to pop back up above 25 there. When you look at the RSI and the CCI, you can see they're also kind of at the high end of these bearish levels and potentially rolling over. The Ichimoku trend, the Ichimoku cloud, we're still well below the cloud. We're below the green line again. The red line's below the price. We're still a very mature bearish trend going. That's on the daily chart. If you look at the weekly chart, just look at the trend strength indicators. Looks like we're having a little bit of an issue there, but it's we haven't been very bullish for very long. I don't know why it's not showing up here. Let's see. Shouldn't be the time interval. But anyway, we are, you can see we're below the cloud there too on the on the weekly chart and below the green line. We've been consolidating to the green line. We've been so bullish, and now we're just in the opposite direction, and we are well below the clouds. So we're not anywhere near being to being bullish again anytime soon. Finally, looking at the Bollinger Bands here, you can see we're still in the middle of the bandwidth, and we are below the, again, point of control in the value area, and the Bollinger Band width has been falling, so it's back down to low levels and setting up the potential for a new leg lower, again, to the downside. When you look at it with the Keltner channels here, right here, you can see that we had the bearish momentum. The bands jumped out of the Keltner channels there briefly. The bands have moved back into the Keltner channels quite a bit, so we're really squeezing here, and the momentum has gone down to practically nothing. It's hard to see the yellow. Let's see if I can change that color from yellow to something that stands out a little bit more. There we go. So you can kind of see there's really, the momentum has gone down to pretty much nothing. So now we'll see if we, break back out either to the upside or to the downside with new green dots. You can see how it fluctuates there. And the expectation obviously would be, considering the rest of the indicators, that we would fluctuate, break out to the downside. As a result, what we decided to do here is a bear call spread, where we buy the put, a bear put spread, excuse me, buy the at the money put, sell one strike away. You can see what that looks like here, and whenever I go to its Analyze tab, here we go to single symbol, you can see about 3/4, there's earnings coming up here in a couple weeks, so we have about 3/4 of a normal position at risk. And you can see we get about an $800 reward for that risk if it stays and gets below that level. In this case, it would be 185. And you can see obviously it's priced to trade within a range between 200 and 177. So getting below 185 would be very easy for this stock to be able to do that. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums, to our Market Outlook, our free Market Outlook forum that's available for our free subscribers. Open up any new threads there, reply to anybody else's threads, and let's keep this conversation going with anything we talked about here in the video tonight. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to our website at marketscholars.com for free, like us on Twitter, Facebook, LinkedIn as well, comment on the video again. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.